Please welcome your panelists for Speed Bumps Ahead, China's Belt and Road Initiative, moderated by author and co-founder of Full Sky Partners. Please welcome your panelists for the Global M&A Outlook, moderated by Wall Street Journal mergers and acquisitions reporter Dana Mattioli.
Good afternoon, everyone, and welcome to the M&A panel. I'm excited to introduce our panelists today. Starting at my right, we have Leon Kalvaria, Chairman of Institutional Clients for Citi. Next to him is Navid Mahmoodzadegan, Co-President and Founding Partner of boutique investment bank Moelis & Company. Sitting next to me is Jamie Sprayregen, a restructuring partner for law firm Kirkland and Ellis. Next to him is Chris Stadler, Managing Partner of private equity firm CVC Capital Partners. And last but not least is John Waldron, co-head of the investment banking division at Goldman Sachs. So let's get started. We just came off of a very busy merger Monday with about $125 billion in deals. Year to date, M&A is at a record $1.6 trillion. And a lot of these deals are mega deals. So I'd like to get your take on what's causing all this volume. Who wants to start?
I'll start. So, Dana, you're right. Very big Monday, very big year to date in terms of M&A volume. And we're seeing that volume across the board, both in the mid-sized deals and especially in the mega cap deals, north of 10 billion, volumes up, 3.5x versus same time last year. And so I do think a lot of that is driven by two or three things. One is it's never been a more important time to be strategically well positioned as a corporate. The costs of being wrong in terms of your asset mix, in terms of your positioning, have never been higher. And I do think many companies are out there trying to figure out what's the right deal to help create the best positioning in a rapidly changing market. Second, we're seeing activism create lots of M&A situations, either as a prophylactic against a potential activist getting into a company. So corporate boards taking offensive actions to make sure that they don't become a target, or companies themselves who've already become targets and then react to that. And third, private equity. Private equity is more important than ever in terms of the landscape. And I think all three of those things are, from a macro perspective, helping to drive a lot of the M&A activity we're seeing today.
Yeah, I mean, those are good points. I would also add, I think, that some companies are also realizing that the positions that they are in may not be sustainable, so that they're willing to enter into transactions, even recognizing that there may be a long regulatory time frame, but knowing that the outcome at the end of the day will be critical for their business. We saw, the Sainsbury-Asda transaction, obviously the big one in the US with Timo, and I think you'll see more and more companies deciding this is the time where they have to reposition themselves either through asset sales or through mergers in order to ensure that they can move forward with growth for the next 5 or 6 years.
To what extent is tax reform driving M&A? That wasn't brought up.
I think getting tax reform out of the way has been important. I think sitting here, if we were doing the panel last year, I think people would have said, there's uncertainty around tax reform and we'll need to get beyond that. I think now that we're beyond that and people understand what the tax regime looks like, I think that's been certainly conducive to M&A. And I do think probably even more than repatriation, I do think bringing the corporate tax rate down from 35 to 21% is going to reduce the friction costs on companies divesting assets. Historically, one of the barriers has always been, well, if I sell an asset and I pay the tax, the net multiple to me is below my trading multiple. And I think by reducing some of those friction costs, I think it'll be a further spur to M&A.
Anyone else have a different view?
No, I think that's 100% right. It's kind of like throwing gasoline on what was an already fairly aggressive fire. I mean, think about all the capital that's backed now on balance sheets. To me, the interesting dynamic, and I think Navid mentioned activism, is the confluence of activism plus all this extra kind of liquidity and capital coming back onto balance sheets, cash that's got to be deployed, and whether shareholders are going to allow companies to take a long period of time to deploy that, or whether the pressure is going to mount to come out with a capital allocation plan that's fairly defined, how much going into the business, how much going back to return of capital to shareholders, and how much going to M&A. And so I'm sure all of us that are spending time with clients that are on the client side of the business, Chris is a client, are spending a lot of time on capital allocation, kind of good old-fashioned corporate finance as to what do you do with your capital and your cash now that there's excess cash for most companies laying on the balance sheet that shareholders are going to kind of press upon for for an answer as to what are you going to do with it.
Yeah, I think also on that, and really hopefully it's going to be great for Chris's business. You will see, John, as you were saying, there'll be less potential pressure for people to spend and more potential for cash sales because the tax hit is going to be that much better, which obviously, given Chris how much is in the private equity world right now, should be fuel for that.
Yeah, it certainly is. I think probably at this point, the percentage of our pipeline that is corporate sales of assets is about as high as we've seen it. And certainly they're moving about it much more quickly than they have in the past, and we think most of these deals will actually get done. And so I think all those pressures that they feel in terms of the activism and knowing that they're going to have to choose their bets in terms of the businesses they're going to invest in.
And I would just add, we've been seeing from the restructuring perspective, people moving in much more heavily into M&A through the bankruptcy process, or just buying into the debt and doing a conversion of debt to equity process in order to get at the assets that way. And the tax reform has also sort of turboed that.
I mean, you asked at the beginning kind of what's driving all this kind of record volume. I mean, I can't think of another time in my career where there had been more cylinders firing, right? So there have been other times where there's been great stuff going on in the M&A market, but the rise of activism is a much more recent phenomenon if you think about the history of M&A cycles. And that's a big propellant for M&A because the first round of activism was much more buybacks, lever up, buy back stock, return capital. This round of activism is much more pushing on M&A, either offensive or defensive. Right? Offensive being go buy something, defensive being deconglomerate, spin, get back to your
Or a third,
focus.
I think a lot of activists are pushing companies to put themselves in play. So
Right.
we're seeing more activity on public to privates than we've seen in quite a while. If you're skeptical, you say, well, it's been a nice run in the stock price. Let me put 30% on top of that and call it a day. But we're certainly seeing more activity there as well.
You have that. You have low rates. Capital is very cheap and very plentiful. You have the dynamism and disruption that Navid and Leon were talking about. In terms of industries blurring, lines blurring, disruption across every business. You have to react competitively. So it's about as good as it gets right now.
Yeah, and you have one additional element, which is global growth. I can't remember, maybe others can, when you've had almost all of the world economies hitting on all cylinders. So you're sitting with 3 plus or minus, depending on which numbers you look at, growth. And I think that is combined to do something that's really critical, which is CEOs feel comfortable doing things, given their equity valuations. And on your point, they also want to make sure that they don't end up in an uncomfortable position vis-a-vis either activism or, frankly, their own shareholders that are inclined to be quite public if they're not happy.
Could some of the regulatory environment or what's going on with MOFCOM right now cause any of this to come to a crash or a halt?
Well, it's already cost Navid and me some business, right now. We were in a security with a couple other private equity firms backing Broadcom's pursuit of Qualcomm, and got an unwelcome surprise from the administration. And certainly we'll see where that's going to end up in terms of how that affects people's willingness to take any kind of regulatory risk against an administration whose priorities seem to be in flux a bit.
Well, I think it's interesting right now. I think the administration has proven to be unpredictable. To Chris's point, I think if you look at, also the Time Warner AT&T situation, I think most wouldn't have predicted the government to bring suit there. Having said that, Sprint and T-Mo just announced a deal, and so you can ask yourself the question, why would they do that in an unpredictable environment? And I think the answer is, I think if you're sitting there looking at the landscape, one of two things is going to happen. Either this will be the administration for the next 6 or 7 years, and it's not likely to get more predictable. Or two, there'll be a change in administration in a few years, and that could be less conducive to regulatory relaxation on M&A. And so if the landscape is changing and the deal makes sense, why not go try it? And I think that's probably the mindset you're seeing with a lot of
Yeah, I would amplify that. I agree 100%. I think the forces of consolidation in these industries are overwhelming the concern on regulatory, because if you actually sat there and looked at the unpredictability, you wouldn't launch most of these transactions.
Right.
I mean, it's a little bit of a scary environment to go test the Justice Department in any of these countries, frankly. But the dynamism and the change in these industries is profound. And so I think that's the tension that exists. And you're right, I think, to ask, is that going to start to unwind some of this euphoria in the M&A market? Because if some of these deals do ultimately not happen, that will give people a lot of pause. Because you put a company in a merger situation for 12, 18, 24 months and then don't do the deal, that's pretty damaging for a CEO and will often cost CEOs jobs.
Right, but you also have some of these sectors, I think on your point, that people feel that it's worth taking the 18-month risk here right now. I mean, you look at the consolidation that is sitting with the regulators right now in healthcare, in terms of people reacting to the supposed threat of Amazon, the real threat of Amazon. And so whether you look at, CVS, Aetna, Express Scripts, a bunch of knock-on transactions. And what you're also finding that I find fascinating and applies in media a lot is one person acts, three people follow.
Yeah.
And you sort of wonder, well, why didn't the other three?
The domino theory is alive and well.
Clients sometimes ask, well, why is no one going after that company? But when it goes into play, three people go after it. Well, because it's actionable. And I think you've seen it in healthcare, you've seen it in parts of retail here, you're obviously seeing it profoundly in media, because they also look at this and say, it's the last piece of beachfront real estate. Well, if I don't get it, it's worth taking the risk, because the option, maybe I end up with nothing.
I saw a statistic in one of the presentations that linked about 60% of the takeover activity to some element of technological or market disruption. So people responding to what they see as a big shift in the strategic landscape and realizing that it's not something that they can spend organically against. They're going to need to reposition their portfolio.
And I would say you're seeing a definite rise in hostile activity. So not only activism, but actual outright raid activity or aggressive action, whatever you want to. Wherever on the spectrum of hostile you want to land. So that activity is up markedly, and I expect that to continue. And that is a sign of kind of late stage, we got to get things done behavior.
But on the non-CFIUS, non-antitrust regulatory regime, we've actually seen other areas of the government where you need different regulatory approvals actually get more functional.
Yeah.
And we're getting some deals done that we couldn't get done during the previous administration.
And I think that's going to be true also for the FTC. I think you've seen that the Senate confirmed all the new commissioners, and so you're going to have a new commission in there that is Republican in terms of its leanings. And so I think in certain areas, I think you'll see more permissive attitude toward consolidation.
Let's talk a little bit about Amazon. They bought Whole Foods. They're in the grocery business. They're studying healthcare. Are you finding that CEOs in industries outside of retail are now bringing that up in the boardroom and doing defensive deals to ward off the threat of Amazon?
I think there's not a single CEO in any large company that is not looking at digital disruption in some way, shape, or form, whatever that may be. And we were talking before, what's surprising to me is CEOs of large companies can end up personally focusing on, $200 million transactions in the digital area because it's so important to get it right and they don't want to be left behind. And I think, if you look at Amazon, even the rumors about them potentially doing something in healthcare, which is, time will tell what they actually end up doing, produces a whole bump-on effect. So every single sector is sitting out there and worrying about being disrupted and wanting to make sure that they invest. And just one last comment, they will look at valuations very differently in those businesses. They look at them almost as an alternative to R&D, an alternative to CapEx, as opposed to traditional value.
I think that last point is really important. I mean, Amazon is the sort of marker that everybody uses for what's really more fundamental across a lot of different disruptive elements. I mean, you could argue the Disney Fox transaction, right, is a reaction to Netflix and over-the-top media distribution, which is really not so much Amazon. It's really much more Netflix. I mean, Amazon's in that game, but it's much more Netflix. But it's the same basic premise, which is we're being disrupted and we have to react. And the disruptor is being given massive permission in the equity market to make those investments. Right, so Netflix and HBO is an interesting comparison. Netflix has got a market value way in excess of HBO, which produces real profits and real cash flow. But the market looks at Netflix and says, keep going, and so they're empowered to keep going. And I'm not saying that's wrong. It may not be wrong, but it definitely gives you a lot of runway to compete with the more legacy players.
Yeah, look, we're in a market, just to amplify, where new business models are being created overnight. And so the digital revolution is enabling companies to reach consumers, to have direct relationships with consumers, to use data, to build better business models. And the whole game is about getting scale and about getting the right assets in order to attack that in the fastest way and in a way in front of your competitors, because there are only certain opportunities and certain assets that will enable you to reach that end game.
And they're watching brands get created. With my old consumer hat from 10 years ago, brands getting created. You take an example from LA, something like Casamigos that didn't exist 10 years ago, 5 years ago, gets sold for $1 billion with amazing social media marketing, as opposed to the old days of someone making sure it got on the back of a liquor truck. So people are looking at all of these different methods and figuring out that they're actually willing to pay up. And one last point, picking up on what you said, some of it is not just the asset. A lot of it is, there's a word for it, people acquisitions. In other words, they actually want the people and the talent because they can't home grow them. So it's a combination of talent as well as the asset.
So would you guys characterize the last round of consolidation as defensive or offensive?
I think it's both. I think it's offensive in the sense that you want to position your company for success in a rapidly changing world. It's defensive in the sense that if you don't, others will, and it can become existential at some point. So I think there's elements of both. There's a race happening amongst companies in these spaces in order to kind of capture growth and capture the right business model. And I think there's elements of both in that.
I think it's advantage in the business or business lines where you can really be the leader or one of the couple leaders in defining and reacting to the change in the industry, and not being in the businesses where you're just not going to win, right? So there's lots of examples where there's defensive de-conglomerate sort of behavior, and there's going to be a lot more of that where you're not winning, and it's a poor return on capital, and shareholders are pushing you to be out of those businesses versus being in the places where you can actually create scale and advantage and be nimble. And so, I agree. I think it's both, and I think it's very dependent on where you sit and which industry, dynamics you're in.
I mean, one dynamic of it is, I remember one of, I think many people here know Steve Bolenbach, and late Steve Bolenbach, and Steve was on my advisory board, and we'll get together with executives from different industries that sit on about 30 boards. And, over the course of the years, the conversation moved from primarily a retail topic and the disruption to really every business talking about the impact of technology and disruption and shortening of planning cycles. Remember at a break, I sidled up next to Steve, and he looked at me, he says, for your companies, if you haven't figured out how technology is going to disrupt their business model, and you haven't figured out how to be a leader in that disruption, you should just sell them. And I think that you're seeing an awful lot of that activity on the part of corporates, where they say, to John's point, that if you're not really going to position yourself in leadership in the new world, that you ought to be out of that business.
Chris, is that driving opportunities for you alongside activism, creating divestitures?
It is. There's no question. We talked about the activism on divestitures. I also think it continues just to increase the costs of being public, which is just wonderful for our business. The easiest sell we have is sitting next to it, sitting with a CEO and talking about the difference of private ownership versus the demands of being public, and that's certainly part of our spiel. And if CEOs and management teams can see a way to get there, I think it is an easier environment in which to operate. We plan for 2 to 4 years ahead, which I think is a reasonable planning cycle with this kind of dynamism in the market, and we're able to make investments without regard to quarterly earnings, and we're aligned with the management team in terms of our own economics. It doesn't make any of this that we're talking about easy, but I do think it makes it easier than being a public company, and I think you'll continue to see the share of businesses that are in private ownership versus the public market. I think that's going to continue to go up.
All right, and there's also a lot more opportunities, Chris, as you know, for private capital to keep businesses indefinitely private. So you're looking at the growth of these so-called core funds where people want to sit and own the asset for the next 10 years, and no one's in such a hurry to go public and take on that burden, which is obviously going to be good for private equity. Big family offices have become major players in some of this. It's a very different dynamic to what
when you're a client up here, you get people like Leon to do your bidding for you like
exactly.
Because we have one of those funds where actually we're one of the first in the business with it, and we're raising the second version of that now, and it's very flexible capital. It's one of its core uses for us is to talk to family businesses who need some liquidity, would like a partner that can help them build the business, but are not enamored of either the public markets or maybe a private equity model where in 3 or 4 years they might need to sell again. And so that's something that we've been focusing on, family-owned businesses with that vehicle.
Yeah, the evolution of private equity groups like CVC and others, have developed this full suite of, solution, based capital, not just controlled buyouts anymore, but, all sorts of different forms of capital to work with companies, public companies, private companies, to kind of help provide solutions, I think is, one of the things that's going to continue to be an important driver in M&A activity, along with the other things we've been talking about. There's about, $1.7, $1.8 trillion of dry powder sitting there within, these fund families. And, if history is any indication, all that money gets put to work, and it'll get put to work helping to kind of create, the M&A trends that we've been talking about.
Yeah, and I would say our fund formation practice at our firm has really exploded with exactly the type of vehicles you're talking about, with being done left and right from the traditional private equity funds.
So we're seeing a ton of secondary and tertiary PE deals. Are big take privates a thing of the past? Could we see a giant take private this year?
No, I think, as I said earlier, I think we're seeing more of them again. I think you need to be careful because, any time you're putting a 30% premium or thereabouts on a business that has been trading publicly at a certain multiple, you need to understand what it is you're going to do to work your way out of that premium. But we're certainly seeing more receptivity to that. There was one that we were active on, unfortunately lost, that was announced on Monday. We're seeing a lot more of it in Europe, where it's traditionally been difficult, and so I think we'll continue to see it.
I think it's getting harder too. We talked about all the strategic activity. I do think putting aside just valuations and increasing interest rates, typically when public companies are for sale, there's a strategic bid out there, so it becomes more challenging.
It's very different than the thing about the 05 to 07 period, where the private equity firms were the buyer of the big public assets and the corporates were kind of on the sidelines. It's a bit of the reverse now, right? The corporates are prepared to step up and pay. They've got massive accretion for all the kind of obvious cost of capital reasons. And the shareholder base is, as long as they're staying in their lane on things that they're good at, the shareholder base is rewarding them and saying, yeah, go ahead, keep going. So it's definitely harder for the private equity firms to compete at these prices at this point in the cycle. But I agree with Chris. I mean, there's going to be a bunch of take privates because there's a lot of capital. And there are assets that are available to be bought, and the capital will get deployed.
Yeah, what you probably will not see is something that goes back to, an RJ or Nabisco or something of that nature, when people are doing a $30 billion deal, taking private, because given the amount of leverage and the multiples that people are trading at, you're starting to talk about, equity checks of 10, 15 billion, which are doable, but on the larger side of the equation. But I think, the point about where corporates are heading right now, the other side of it, which I think actually somewhat also plays into a bit of private equity, is my personal view is that these massive cost-cutting exercises on some of these things are not necessarily get looked at that favorably from the standpoint of the world that we live in. So people are also being very careful as they go forward, because everyone's conscious in the world that we live in, it's not enough to make good profits. Profits have to be made in a good way. And so they're conscious of the environment, the political environment, et cetera, as they do some of these exercises to make sure that they don't invite the wrath of whoever may care to comment on it.
Targeted tweet.
I don't know how to tweet.
On that front, I've heard from some people that companies are really reluctant to announce big synergies on deals because they're worried that the Trump administration will attack them, and we all know that synergies sometimes means jobs cuts. What are your thoughts on synergies and how you express that to investors?
Yeah, I haven't seen that. Look, Sprint T-Mobile announced $6 billion of synergies the other day. They weren't shy about.
Which equates to a big number.
Which equates to a big number, and I still think, look, you have to articulate, to John's point about getting rewarded for these corporate transactions, you do have to articulate the rationale, the economic benefit, and why you're doing what you're doing, and synergies is obviously always a part of it. So I do think people are being more sensitive to the discussion around jobs. I think they're being more sensitive to the discussions around nationalistic issues. But I think at the end of the day, I think you have to be open and transparent about why you're doing what you're doing, and part of that is the economic rationale around the transaction you're announcing.
I would actually, I agree. I would say synergies are the driving force of what's going on right now. So there was that moment right after the election where there was a pause. I mean, we all thought coming, at least in our firm, and I suspect most people in our business thought coming after the election of Trump that there would be this wave of M&A because it presaged a more conducive environment. And actually, it was kind of a big pause. There wasn't a lot to do in that first 4, 5, 6 months. And I think part of it was the tweeting and the being called to the carpet by the administration and being told you can't close a plant in Michigan. I think that's long gone. And I think what'll be interesting is when you look 10 years back, 4 or 5 years from now, when this is all kind of wrapped up in a bow and we've gone through the next cycle, how much of this synergy value actually produced real economic returns. But these deals are fundamentally based on significant synergy value, all of them.
It's synergies and growth. You have to have growth, because I think when the market looks at pure synergy deals that don't really change the nature of the business, they don't love it as much. And I think one of the things that I've just seen change in the last 6 months also, and I'm sure you all have done the same, and that is how you present the deal, how the whole thing looks. The PR, it's not just an IR issue, it's a PR issue from the standpoint of presenting something that looks like a responsible transaction that makes sense for everyone, is getting a lot more focused than it may have gotten 5 years ago.
That's an interesting debate, because you think fundamentally with all the excess stimulus and everything going on, we're still in the United States growing 2 and change %, right? So there's not a lot of GDP growth and there's not a lot of top line growth for most companies, set aside the big disruptors that have this massive wave.
Also at more or less full employment, right?
Yeah,
so I think there's a lot more focus on job loss and synergy when the unemployment numbers are high. From our perspective, we really do believe, we have a lot of public pension money and they care about what we do with these businesses, and it's our mission to make sure we leave the company better than we found it, and that's for our investors, but that's also for employees and customers. And what that'll usually mean is there may be some improvements that you need to make and get yourself to the point where you're a leader at providing the service at a leading cost. But from there, you're going to need, to Leon's point, to grow the business. And it is so much easier to sell a business that's growing than one that you've just taken a bunch of synergies out and now you turn it over to somebody. And so we always look at it as, when we do that, we're doing it to maintain a leadership position. And we're going to take some of the money to the bottom line, but we're going to reinvest a lot of that money in areas that the company can grow.
And I think on the political issue of the loss of jobs, what I've seen in the world I live in of creative destruction, there's never been a better time to be laid off, actually. And we've had a bunch of situations where a lot of people have lost their jobs at that company. They've literally been reemployed, literally in the next couple of weeks. And so that's a positive time, not like 07 or 08.
Now that's a restructuring guy talking, right? Like, never a better time.
I don't know, is that a quotable?
Yeah.
On balance, has the Trump administration been positive or negative for M&A?
Very positive.
Positive.
100% positive.
I mean, it has to be. You look at, starting where you were before, at the end of the day, people talked about tax cuts and then it happened. So it has a positive effect. I think you have an administration that is viewed as business friendly, however you want to define it from that standpoint. And I think in the US, it's certainly been, I think it's a big confidence booster. People feel good about going after transactions. And when they feel good about it, the mood in the boardroom is better. People are prepared to do things that can improve, as you were saying, Chris, their growth profile. And they know at the end of the day here that there couldn't be a better time period here to make sure that they act while, frankly, interest rates are still low, equity prices are reasonable, the numbers all make sense. And if you look at all the statistics that our firms have, acquirer prices have gone up on these transactions. So at least for the moment, John, maybe we'll see 5 years down the road, but at least for the moment, people like it.
I agree. And the other thing we haven't talked about really is deregulation. If you imagine, put your politics aside, if you imagine a Clinton administration, you probably would have had at least neutral regulation to what was in existence before, if not more regulation. And we now have, even without the existence of any legal change in the apparatus, just in terms of enforcement, much less regulation. And the prospect of more deregulation, which I think also gives people more confidence to keep going from a deal standpoint and a strategy standpoint.
Great. On the private equity side, we've seen some firms shy away from retail deals. I'm just wondering what the appetite is to buy a retailer right now.
So we have a couple in our portfolio, and they're ones that have, for the most part, navigated the environment pretty well. We had one that was, I would say, very attractive in terms of how it performed. The management team was great, but getting a private equity firm to stroke $1 billion equity check right now into a retailer is not an easy thing. And so I think
Yeah, that's the Nordstrom family.
yeah, that's true. That's true. So look, I think that we're beginning to see some winning formulas, and I think if you were listening to Joe Tsai talk yesterday in a lunch about how they approach it, and they're very much thinking about retail units that are just much more structured to be distribution units as well, and so much more of what they call dark store, with the larger back of the house, seamless inventory between online and what's sold in the retail store, but very much a retail presence. And so you're going to see that. I think any business that we like to call relational retail, where there is something about the product that is requires establishing a relationship with the customer, and they have questions and things. Those models have certainly done better, and I think more and more of the floor space in a retailer is going to be dedicated toward the provision of services and not just product. And it is a big investment in the U.S. for retailers to get that inventory seamless as between online and what's sold at the store. But that's where the money's going in order to make it a more competitive proposition.
Yeah, although we're also seeing a number of private equity firms, as you well know, Chris, also doing growth retail investing. In other words, putting, as you well know, putting money into disruptors that they like, as opposed to a traditional take private, etc. And so we've seen a number of them go into very interesting direct-to-consumer retailers, leaving them in a private format and recognizing that they will probably ultimately be M&A candidates. And get control.
M&A candidates, or the IPO market.
Or maybe,
so the IPO markets are starting to feel strong again, and I do think, I know this is an M&A panel, but I do think we're potentially on the cusp of a major wave of IPOs. A lot of very high quality companies that haven't accessed the public markets because they've been more difficult over the last few years, I think are prime candidates to head out there, and eventually, after going public, could either be acquirers or themselves targets for M&A. So,
Jamie, with the economy sort of firing on all cylinders, what are your busiest sectors right now in restructuring?
Well, you just mentioned retail. That's probably the busiest, and it's apropos to what you're saying. The people who've kept me the busiest are the ones who didn't do the exact type of things you're talking about, and so we learn a lot about what not to do. So that's by far the busiest. Energy was 80% of our business from 14 to middle of 17. That's down 80-90% now, but there's still a decent amount of energy that even at the current oil prices still doesn't quite work. If it keeps going up, maybe it's going to work, but we've had a number of restructurings that have turned into M&A deals as a result of them needing to transact. So those are probably the two busiest areas. And then we already talked about technological disruption, and that's not industry specific, but we're seeing a bunch of, it depends on which business didn't handle it well, but in idiosyncratic ways across industries.
So 2015 and 16 were colored by these giant Chinese deals into the U.S. that have all but dried up. Just wondering if you think that those deals could come back, and if not, if there's a different geography that's filling the void.
Yeah, I think it's hard. I mean, at least at the moment, it's hard to necessarily see a lot of outbound M&A coming out of China. But that environment could change. There's plenty of capital around. But for the moment, it seems quieter. I think you're seeing much more going on in other marketplaces right now. Certainly, for example, intra-Europe, where there is even ex the UK within the European market, you're seeing more going on there. But I think the period that you're alluding to of 15 and 16, where there was massive Chinese outbound investment, it certainly hit a pause button. And I'm not certain at what point in time, someone's going to hit the play button.
yeah, two markets that could potentially fill in the void. One's Japan. Mm-hmm. Japan's historically been a slower growth market. I do think there's many of the corporates there are looking to access growth and buy assets in other countries. I think the Shire deal is sort of an example of that. And then there's obviously incredible things happening in Saudi Arabia right now. Obviously sitting on major sources of capital, PIF, et cetera. I do think they're looking for ways to transform their country and transform their society and transform their economy. And I do think potentially investment, either investing in businesses or buying businesses outside of the country could
No
be
doubt.
part of that agenda.
Great. We spoke a little bit about this, but there's been this shift from conglomerates and to deconglomerization. We've had companies like GE say that they're going to break off pieces. Just wondering if you think in the next cycle that we'll just be building these companies back up. That's sometimes the way M&A works. You build it up, you break it apart, and it gets built back up. So what's the future of the conglomerate?
Well, I mean, in the current environment, the future of the conglomerate is you better be really good in all those businesses. So I think conglomerate is a kind of historical term. I don't think shareholders want you to be spread all over the place. They want you to be excellent in what you're doing. So the future is hard to predict, but if disruption and the pace of change goes the way it's going now and continues to accelerate, I think it's going to be very hard to be world class in enough businesses to be called a conglomerate. Yeah. So I think it's very hard to be an asset allocator today, if you're not running an institutional fund or a private equity firm or something where you're being paid a fee to asset allocate as opposed to operate businesses. And I don't see conglomerates being at all the wave of the future. Now, it's hard to predict what happens 5 and 10 years from now, but it's hard to see how that would be the
I mean, the reality is also, to be honest, if these places don't do it themselves, someone's going to come in and do it for them.
Right.
So every single conglomerate has had most activists at least run through the numbers to see what makes sense. And I think people are also finding that not only is it hard to be excellent across so many different businesses, but it's also hard for the marketplace to understand them from an equity research standpoint. Can you really have someone that understands every single one of these sectors, or do you end up with lowest common denominator evaluation, in which case, welcome to 102 Act.
I think shareholders want to actually do that themselves.
Correct.
Right?
Yeah.
They want to allocate the money where they think it's best allocated as opposed to have one player allocate in 6 different segments.
I think
Unless you're Warren Buffett, right? Unless you're Berkshire Hathaway.
Yeah.
It's probably the only exception.
He's getting a free pass.
He's getting a free pass.
Probably will until the very end.
And he can do whatever he
He
wants.
can do whatever he wants.
Certainly CEOs, the public CEOs that we talk to, if there's not a clear unifying theme and skill set and value add that they know how to apply, and that can't be part of the communication to the market about why they own what they own, they're starting off on the back foot right away. It is hard enough to communicate to the broader public equity market exactly why you're in what you're in and what you're good at, and if that's 4, 5, 6 messages across different business lines, it's just going to get lost.
Yeah, and I think there's a message, and you've seen it. I mean, you saw what happened on DuPont, which was sort of an interesting case study where, they ended up, winning war number 1, and then war number 2 or transaction number 2 occurred, within weeks, months thereafter, and produced one of the most, profound starbursts that's been done in a long period of time. I think other CEOs look at that, and they, whether it's at the business roundtable or wherever they end up together, and they look around, they all share their stories, and I think they're very, very conscious of making sure that they don't end up in those kind of positions and have sort of a career-ending venture in the face of an activist.
Yeah, I agree. I think the activist impact has been significantly beyond the specific activist situations. I think it's caused corporate boardrooms to react offensively and proactively to not be a target, and so the general impact is much more profound.
Do you think activists have picked most of the low-hanging fruit?
Well, so I think it's interesting. I think one of the trends you're seeing is significantly increased activist presence in Europe, and I think part of the reason for that is there's less opportunity here in the U.S. I think given where valuations are, a lot of the easy ideas have been already picked over and already been acted upon. Mm-hmm. Boards have reacted proactively. The opportunity is a little different in Europe. The rules are different. The governance regime's different. So I think the activists have to go about it in a different way than they do in the U.S. But you've seen a significant pickup in activity in Europe, and I think part of that's because a lot of the good ideas have already been dealt with.
And they have to build a real infrastructure. I mean, you look at some of the marketplaces. I mean, South Korea, that's had some significant activist behavior. Australia. I mean, marketplaces that have a system where they can actually operate, but it does take, from an activist standpoint, some real infrastructure and some serious work. It can't just be done out of Park Avenue. They've got to have a local presence, and obviously, there's some folks that have done quite a job, like Elliott. and a very, very significant offshore presence.
I mean, I think they're definitely going offshore, but I would say 25% of the S&P 500 of the market cap of the S&P 500 has an activist in the equity. So it's quite prominent in the United States, and I still think it's going to get more prominent. And I think what they've done is they've gone after bigger companies. It's back to your conglomerate question. They've gone after the bigger companies that are more spread out, where there's more levers to pull to create value. Because you got to remember, they've got a shortish term time frame to create value, and they're looking for multiple ways out. If their first thesis doesn't work, there's got to be 2 or 3 other backup plans to create value. If the board says no, or the transaction they think could happen doesn't happen, or there's tax that they didn't think about, or whatever the case is. So I just think they're going after bigger names where there's lots of levers, and I think that's going to continue until it doesn't work. There was a period where the returns were pretty pedestrian, and they started losing capital, and the campaigns went down. I mean, we're seeing more campaigns this year than we have in the prior 3 years. So they're alive and well, and the U.S. is still going to be by far the best and most active market.
No, they're also having to refine the way that they're approaching it. So if you look at the nature of the approach going back, 5 and 10 years ago, you'd had simplistic approaches about leveraging up, share buyback, things of that nature. You now have to have a much more sophisticated, thoughtful, sort of industrial approach to take to these companies, and they're doing it because they know that if they come with something that's too simplistic, they're not going to get any kind of herring and anything like that. So I think the industrial side of activism that certainly some people have done has garnered boardrooms' attention here in this environment.
To what point is it more important to interact with smaller shareholders when you're announcing a deal?
You mean retail or small?
Institutional, or not the activists, but other shareholders that might have significant positions.
I mean, look, we see it on a bunch of live M&A transactions. I mean, just simplistically, and the rest of the panel knows better than me. I mean, the real issue is, what does your shareholder base look like? Number one, how important is retail? And number two, what's the nature of the question you're asking? Because you want to ensure here that people actually have the basis for the information. So you're seeing much more digital outreach, websites. And by the way, while companies are doing that, it's also relatively easy for people on the attack to do the opposite. So you've got, the No Leon website. It's very easy to put that up in about 1 minute and point out all the reasons why that's correct. But that's the nature of what you have right now. So it's important.
Yeah, and that investor outreach is important, because I think what we've seen in some of the activist situation is the long-only non-activist investors actually behind the scenes inviting activists to come in here. They can't really do it themselves. They're not equipped to do it. They don't really want to be visible. But I think there's been many situations where you sort of hear anecdotally that there are long-only funds in the background stirring the pot a little bit. And so I think one of the things you want to do is make sure your investor base is understands what you're trying to do, you're communicating constantly with them, and your strategy is clear.
I think one of the challenges today is it's harder to know who your shareholder base is, and to have a real relationship with them, because there's more passive money, there's more quantitatively driven algorithmic trading strategies. The long-only funds, as Navid rightly says, may not be totally genuine with the management teams. They may say one thing that sort of allows them to maintain the notion of being management supportive and quietly cheering the activist and spurring the activist on in the background. So I think it's a much more nuanced, complex set of relationships and narratives than what we have used to see back in the day. And when you're announcing an M&A transaction, or you're in an activist campaign, it does become more like a political campaign, where you have to hit all the aspects of the shareholder base, even those you may not even know well, and you got to use all the methods, digital, regular way, meetings, et cetera. So it's a more complicated equation, which is, I think, good for the advisors, because it makes us more relevant, more valuable, and we've got to be on our game. But it's getting harder for the companies.
And it's also different if you're in a live M&A situation that requires a vote and someone's intervening. That's one scenario.
Yep.
If someone has come with a bunch of proposals, written letters, etc., that then also it's sort of different, because you've got to really evaluate what we're doing, because the company also runs the risk that they do certain things and then they look at their shareholder registry 3 months afterwards and the activists have sold their position. So it does actually, as you said, give us advisors some reasonable role here to be able to maintain full employment, but it's a very, very
Thankfully.
important, it's a very important aspect of it, because the nuance is much harder.
Let's change tacks a little bit. With so many startups staying private longer, how does that affect the M&A ecosystem? talking about the Ubers and the Lyfts of the world that are just these really giant startups?
Well, look, I think as we talked about earlier, I do think some of those companies are going to access the public markets here soon. I think the ready availability of private capital has enabled them to scale to unprecedented heights in the public domain. Some of those companies have, because they have such large pools of capital. Airbnb has done a bunch of acquisitions, et cetera. So they've been able to actually participate in the M&A market, even though they're private, which is sort of unique. Because they're sitting on and have access to capital, and I do think by going public, I think they'll be even more ready participants in the IPO market.
It's probably, I agree with that. It's probably, this is debatable, but I think it's probably actually muted some of the technology M&A that you otherwise would have seen, because more of those companies would have ordinarily gone public. They would have had less capital to prosecute their business plan, and they probably would have gotten swallowed up more so by some of the larger players. Now they've gotten bigger on their own with more capital, and they've gotten to in some cases to a scale where they're not viable. They're too big. I mean, there's not that many, technology players that are going to go buy a $50 billion, emerging growth company that trades at a very high multiple, because that tends to get fairly dilutive at that size. So, I would actually argue it's probably been a little bit of a deterrent in terms of volume. But I tend to agree with Navid. I think it's going to a place where there's going to be more activity, because some of these unicorns have now got to start to become public or deal with the fact that the private capital and the values have gotten to a place where the next move isn't probably another 20% lift in value, and so they've got to start to deal with that, and it's going to become harder to keep their employees and everybody happy and liquid, at this level of the game. So my guess is we're probably on the cusp of a much more active period.
Yeah, and I think the real issue is, private market valuations on some of these names have been pretty robust. And I think in some cases, people may be worried about testing the public market because they want to ensure that they can at least maintain those kind of valuations.
Yep.
So I think, Navid, on your point, I think they'll watch the market carefully to figure out at what point in time valuation and receptivity can actually
We did an
coincide.
IPO to that point for Dropbox
Right.
Below the last
recently,
round,
and the actual price of the IPO was below the prior round, but the stock traded above the prior round, so it kind of worked.
Which is perfect.
It was pretty symbiotic for everybody, but that's a nuanced and a sort of dancing on the head of a pin, and it didn't have to go that. It wasn't necessarily embedded that it would go that way. So these things are going to be complicated, I think.
So if we could talk a little bit about liabilities and deals. The Harvey Weinstein deal fell apart because of liabilities around sexual harassment. I was wondering if you're seeing more instances of sexual harassment or a company's culture being a liability in deal making.
Whoa. Navid's going to answer.
I'll answer that. We're involved in that. So yes, of course. Look, the culture, the fabric, the DNA of a company, its people, its governance, all of those things are critically important, and ultimately one of the factors that any acquirer of a business has to look at when they're looking and evaluating a target. So it's a huge issue these days. It's a relevant issue, and it goes to what you're buying and how it's going to integrate in your company. And so I do think that there's sort of the legal liabilities and what risks are you taking by doing a transaction. That's kind of one set of issues. But as important is the quality of the people and the IP and all of the things that make a transaction work, and evaluating that in today's environment is critically important.
I mean, these cultural issues are absolutely critical because, not only is it the right thing to do in terms of how you operate the business, we all know that, but it can significantly impair the value of the business and the ability to raise capital if a company gets off track, and these things can snowball. So there's obviously a major premium in terms of what Navid is saying to ensure that the culture is appropriate for the world that we live in, and frankly the world we've always lived in from that standpoint. And it's a bigger and bigger issue, and something, as I've described it to some people, small issues have to be looked at real carefully because they can produce gangrene and amputation in a matter of weeks if they're not properly dealt with, and people do not want to infect their own company under the wrong circumstances.
Yeah, as to the legal liability point, that's again where the restructuring and bankruptcy guys come in. Weinstein's a good example. You couldn't get that company sold outside of a proceeding. Inside of a proceeding, that's again the beauty of the system. If it's necessary, you can sell it free of all those liabilities, and then they're taken care of through what I call the car wash taking through the rest of that process. But you can at least transact on the assets and get them into safer pair of hands.
Certainly, for our investors, it's a very important issue. Again, I mentioned a lot of them are state pension funds, and it is at the top of their list, both in terms of liability issues, but more importantly in terms of developing a winning culture in that regard with respect to diversity and inclusion, and really being a leader in your industry about making it an environment in which everyone feels they're given the chance to succeed. And so that's important for all the businesses we buy. It's important for our own business. Our industry has not been great at producing those kind of opportunities, so it is a real focus area for us. And I think we're seeing more progress on this issue in our company, certainly in terms of using new tools to get to move the needle, really.
Yeah, the only thing I agree with what's been said. I would just add that I think more of the right questions are being asked around culture and behavior and patterns of behavior in certain companies as to whether it's really a buyable company and a company you can integrate into your own business based on things that have nothing to do with economics or math or multiples or any of that. And I think that's a fundamental shift.
Yeah, I mean, there's no doubt on your point that, if things go the wrong way, you can render a company unviable, at least until it's been solved.
So is it coming up more in due diligence or cultural issues coming up in the
I think so.
rooms?
I think it is. And it's easier to do some of this diligence in terms of online sources about what employees say about their company. We've all always done the legal work around. Tell us about the cases you've had, the complaints you get, et cetera. But I think more and more looking at what employees have to say about where they work is an important part of the diligence that we do.
Chris, do you go through and look at some of these issues like on social media and things like that when you all do your diligence?
We do. We do. And look, a lot of people will talk about the fact that, that those sites will attract the people who have something to complain about. But I think more for us, that's a place where you start, and then you want to talk to the company about what do you do to hear your employees and to listen to your employees. What processes do you have to collect feedback? The best companies will do net promoter scores of not only with their customers and their suppliers, but they'll do it with their people. What do their employees say about what it's like to work there, and what actions do they take on the feedback that they get from their employees?
So to wrap it up, I'd like to just go across the line and ask everyone their outlook for M&A for the rest of the year. Your crystal ball is ready.
Okay, I guess I'll start. I mean, look, I think first quarter was great. The weeks after the first quarter were even better, and I think we will have an environment that is going to continue on here for a while, barring any major regulatory issue that looks like the environment is changing. So I think from our standpoint, it's going to be a robust environment, cross-border, private equity, all of it. I think we see a good time.
I agree. Merger Monday's back, and Merger Tuesday and Wednesday. I think it's going to be really active. So we're very optimistic, absent some kind of shock to the system or something none of us can foresee. I think we've all said in different ways, all of the forces are aligned for more M&A activity. So we're optimistic.
Well, in the counter-cyclical world I live in, it's down, and that's good for America. But having said that, I would say one spot we're seeing a lot is, I mentioned our energy restructuring business down 80%. But what happened, and a lot of those companies came out of the process with a lot of unnatural holders. And a bunch of distressed hedge funds own a lot of the energy companies, not in a concentrated holdings way. And I think you're going to actually see more M&A activity on that as those guys trade out of those positions.
I would agree that the environment, the outlook is positive. I am worried about the higher level of volatility we're seeing. I think the government is taking what is a higher risk strategy toward its trading partners, and that can work and it may not. And I think if you see some real changes in how countries view global trade and receptivity that way, I think it could be a big change. And the other caution I would say is, usually when you sit here at one of these things and you talk about everything hitting on all cylinders and you don't know what it is that's going to change it, you're coming close to an event. So
Yeah, it's always tough to go last in this sort of thing. I hate groupthink, but it's hard to disagree with anything that's been said. So I mean, I think our forecast would be exactly as has been said, absent some shock, of which there are many potential shocks out there. So it's not without risk. I would say I think there'll be more parts of the economy and more parts of the industrial, the industries that play in the economy participating. I mean, it's been pretty dominant. I think the first quarter, I think it was almost 50% of the volume was TMT and NR, natural resources writ large. That probably isn't going to persist all year long. I think there'll be more, more deals in other parts of the food chain, so to speak, that will be, participating, which will continue to propel the volumes forward, absent, a change. So, it feels pretty good. But Chris's warning is the right warning. The group think and everything going up into the, to the right is not always the way it turns out.
We'll end it on an optimistic note then. Please join me in thanking our panelists.